Good morning. My name is Charles Heenan. I work at Kennox Asset Management. I'm one of the founders there. With Jeff Legg, I run the investments at Kennox. We've got about $500 million US under management. And thank you very much for the chance to present to you today. Let me start. Excuse me. Let me start by saying that the focus of today's speech is on research and on the specific idea, but we're big believers in the holistic, so I want to briefly touch on a few of the other aspects of asset management that we feel are essential. These are aspects that are key to getting a well-rounded investment firm: philosophy, decision-making, portfolio management, and resolve. And by way of introduction, let me first say something about that last point on resolve. This boils down to one question. Do you have the mettle to stick to your guns when the going is tough? And I'm sure if the value managers in this room will understand the last few years have not been the easiest for a lot of us. So essential to that for us is the structure of Kennox. That has been unchanged in the last 12 years that we've been working together. We're aligned. We make no compromises on how we run money. So Jeff and I have 100% of our equity wealth in the fund. We see all investors as co-investors. That independent point is absolutely core to us. The founders of of the business are the owners. There are four of us. And lastly, we're focused. We do one thing and one thing only. We have one product because we can believe you can only be 100% committed to one thing. So taking together this alignment, independence, and focus, we're trying to minimize the focus, the forces that push us towards the consensus, towards the benchmark, towards what's fashionable. In other words, that might undermine our resolve in doing what we think we do, which is a little bit different. So put together, these give us the best environment that we think we can make to make a very strong, differentiated, powerful returns for us and our clients. Just a few minutes on philosophy. Again, the context is very important on any idea. Value means different things to many different people. So what does it mean to us? Two key points here for us is risk focus and differentiated. So I'll start on risk focus. It's one of our key objectives. It's always at the forefront of our mind. And our history has backed us up on this one. First of all, you can see the majority of the time we've been able to achieve lower drawdowns in the market. These are the drawdowns. 10 out of 12 we've come down less in the market. That comes at 12% drawdowns for the market. We draw down at 5%. Also on volatility, you can see the classic standard deviation on the x-axis. We're quite far off to the left and traditionally have stayed quite low volatility. Risk is inherent in what we do. It's always what we think about, and the whole investment philosophy and process revolve around this. So hopefully that'll come through as we go through the process. The other side of this was differentiated, and just a slide we use here. We're buying when things are difficult, in times of uncertainty, in times of headwinds, and you can see that they come right time and time again. So it's powerful, interesting, yes, but the key here is that it's differentiated. It's differentiated from growth. It's differentiated from momentum. It's differentiated from what a lot of the market is trying to do. Why does that matter? It comes down to that mean that our performance can be very different to markets, and that's important especially because it can come through even in very tough markets. So risk focus and differentiated are two key objectives. How do we go about this? First off, we take advantage of an anomaly. The market has a tendency to massively overreact when even the highest quality company is facing a period of short-term uncertainty. We like to call those headwinds. These headwinds cause the share price to move. Is it a genuine opportunity or not? Only if the headwinds are temporary. So that's what we spend our time thinking about. We challenge the consensus, and if we find that the consensus is overly pessimistic about the headwinds, then we have a genuine opportunity. To exploit this inefficiency, our first point here is time. If you can think longer term than the market and be patient, it's a great strength. So you need to be patient to wait for opportunities, be very selective. You have to be patient to hold while those headwinds turn to tailwinds. And we do think this is very rare. So we run a 29 stock portfolio. Our turnover is about 15%. That means we're looking for 2 to 3 ideas a year. We do also think in terms of quality. Everyone, again, talks about high quality, but again, how do we think differently? Quality is often associated with growth. For us, actually, quality isn't about growth, it's about sustainability. What is the underlying health of the company over that longer term period? So our view of quality is more about focus on risk and less on growth and return. So we do have sector leaders. We think all our companies are sector leaders, but let's see if we can back it up with other risk factors, always looking for low levels of leverage if we can find it. And you can see we have low absolute levels and low relative to the market as well. Management, we're always looking for the long-term time frame. So about a third of our companies are owned, family-owned, have a shareholder that's aligned to that long-term time frame. And lastly, track record. The average age of our company is 60 years in the portfolio. And as a risk focus, that's lovely because you can see how they've gone in the tough times as well as the good times. Moving on to the last piece in our puzzle, the valuations. Market's currently asking 25 times earnings for a lot of companies. We think this is too high a number. It's implying a very low return for a risk asset. And then often you're looking at current earnings, and we're saying, well, what happens if current earnings are overstated or bloated? So what we look for is a multiple. We're paying up to 12 times. That implies a risk return rate that is high enough for your risk asset. And secondly, we look at sustainable earnings, so what a company can realistically sustain over the longer term. So in a nutshell, this quality, valuation, and time, you put them all together is very, very powerful. I'm going to spend just another second on that idea of sustainable earnings, what we see. So Jeff and I developed this as a way of getting a conservative estimate of what they can earn, again, over a longer time period. This is the outcome of all the research, so all the digging and the philosophy put together, and it comes down to a few considerations, always looking for a concrete competitive advantage. Can you come up with something that makes you think, hand on heart, in 10 years' time, your company will still be generating good profits? But also, sustainable earnings discounts peaks, so we're discounting whatever it takes, sometimes sales, earnings, margins. We're marking down companies with leverage. We're always analyzing the cash flows alongside the accounting earnings, looking for the accounting anomalies. And overall, you're trying to take out any over-optimism and build in a significant margin of safety. So aligned with our long-term horizon, the sustainable earnings is logical, and it gives us an unemotional basis to make rational investment decisions, especially in extreme pricing environments. So coming on to what that actually looks like in practice, and for those of you, I'm not sure how easy it will be to see at the back there, you can see that this on this side here is in the bar chart in the back. It's very light blue. That's the historic earnings when we're looking at our company. This company, we've done our research. We've said that we think this is a real sector leader. You can see the reaction in the share price as they've come under pressure for a bit of news. And we're saying, we think this is a sector leader, but we're still going to be conservative. We're still not going to give them any benefit. This is our sustainable earnings number, and it's a touch over the lowest number it's been in the last 10 years. So we think we're being conservative there. On the right, we've put up our sustainable earnings multiples. That's at 10 times, 15 times, and 20 times. These are a buy and sell discipline. We're buying it under 12 times. Between the 15 and 20 times earnings numbers, we say this is going to be a smaller holding for the position. And at 20 times, we think it turns into a growth investment, and it's probably for someone else. So our view on this company that we're researching, it's on 12 times sustainable earnings. That's a genuine opportunity. How interesting. Overpaying is a risk for us. This valuation discipline, a low multiple of a conservative sustainable earnings, that's a logical outcome to protect against this risk. So coming on to the stock of today, normally, value management is about the ick factor. I very much enjoy that. I think it describes a lot of what we do. It's about the unfashionable and forgotten bits of the economy. Today, I'm going to talk a little bit about an exciting opportunity. It's around one of the most powerful trends in the global economy and the global markets right now, and that's the move to mobile. It's the communicating, browsing, transacting, gaming all over on mobile devices. And it's important to say, no, I am not going to pitch you Apple. That is not what our view of risk. However, does it feel that the market is implying that Apple is going to take all of the profits in the sector? Is it? Obviously, history says it's not. You have to have multiple players making money across the sector, or there isn't the investment necessary to maintain what is has become an essential service. So we're saying maybe, but another question, is there any value in this, a mobile phone tower? Actually, not much. But what happens if you had a network of them? And if you had the best network of all your competitors? And you had the systems and the software to connect them to the phones, billing and customer support systems, stores and distribution, brand in the market. If you've got all these, suddenly the barriers to entry are very, very high indeed, and we think they've got real value. On top of that, what happens if you can get that in the world's second largest economy and one of the fastest growing economies in the last few decades, a veritable miracle. As I said at the beginning, we are all about risk. There is a low-risk exposure to get a trend in this trend towards mobile. It's got a few advantages: oligopolistic, agnostic to big brands, and the business model by its nature is using the network effect to create huge amounts of cash. So we do think there are ways to make money other than Apple in the market, and most interestingly for us, it's also available with lower risk, in our view. I don't need to tell you what company we're talking about before. I've said both the words. It's China Mobile. So it's the largest mobile company in the world. It's got about 1 billion customers. That's more customers than the third, fourth, and fifth largest countries have in population. Also, it's got the best network in China. So at first glance, this looks like a great franchise. And make no mistakes, this has been one of the great growth companies in the world. Has been. 2008, 2007, 8, that sort of period, it was up there. Look at how quickly things are growing. Look at the subscriber base is growing, the profits as well. And also, it had two of the hottest buzzwords of the time, which were China and mobile, both in the name. Wonderful. So it was one of the great hot stocks, growth stocks of the world. But fast forward, a variety of reasons come till now, and it's fallen from grace. How interesting. That's where we start to say it's interesting, but let's do our research. Let's distill down to the key ideas. Let's go through all the detail, but come down to the key ideas. Our process is always to challenge the consensus. See if we can find those concrete competitive advantages. See if we can get conviction. So what's the consensus? China's economic growth is slowing. Is that going to slow forever? Mobile infrastructure is dull. Apple is all the excitement in the sector. And China Mobile is going to spend themselves to death. Well, first off, let's start talking about the economy. We have no more information in the short term than anyone else about what's going to happen to China's economy. But remember the point on time from our philosophy. If you can really think in long-term time frames, you have a great advantage over the market. What's the long-term outlook for the Chinese economy? No doubt there is risk. Levels of debt there are very high, and I don't need to tell everyone here that it is run by a communist government. So without doubt you have huge risks. But equally, China's economy is big enough to matter on a global scale. It's got a hardworking and I would say even innovative population, and it can be a fearsome, fearsome competitor, as many, many people have and industries have experienced over the last little while. This has been a real miracle over the last few decades. And it's now the world's second largest economy, with some not unreasonable expectations of becoming the largest. All in all, we think this is something that could be very interesting, but it is still risky. So our view is, if you can own the core infrastructure, is the best, the most attractive way to get exposure to these emerging economies. So having the safety of a pipes-in-the-ground type investment is very attractive when you have a volatile but growing economy in the longer term. So emerging markets are exciting. To offset the risk here, go for the safest possible investment. Second point, Apple wins all. Apple's exciting, China Mobile's dull, the market isn't interested in dull. Well, let's think about this. There is no chance that the telco providers of this world won't make enough money in the long term. There are different segments in the value chain. Obviously, some will do better, some will do worse. Weaker players will go to the wall. But if you have a dominant player, you have to be able to make money to be sustainable, or there is no service. If there is no money to be made in the utility end of this market, there is no ecosystem and there is no Apple. That is a simple but powerful effect. So yes, the utility end is dull, but here we've got the best positioned player in an oligopoly, low risk, generating tons of cash, high barriers to entry. That's the type of dull that we're interested in. And lastly, the spend on CapEx. China Mobile is spending a lot, and that is a key concern for the stock. There's no questions about it. The capital allocation strategy is a key question for this company. But that does also have a silver lining. And the silver lining is that they have the best network already, and this CapEx is only increasing their lead over their competitors. So this puts them in a terribly, terribly strong position. Let's look at these two outcomes. Either prices stay low and the other two competitors struggle, so China Mobile becomes in an even stronger position, or prices rise. One way China Mobile does fine, the other way they do very, very well indeed. Fine or good, there isn't a bad option there. That's the type of risk profile that we think is most attractive. Turning to our sustainable earnings, you can see we've challenged consensus. We think they have concrete competitive advantages. And in fact, we think the franchise is robust and even very well positioned. We're still going to make a conservative earnings assumption, and you can see here we're judging it to be about 130 million Hong Kong dollars, in the same scale as they are there. You can see the line across that. That is about the lowest in the last 10 years. On about 12 times earnings, there's the 11 or 12 times sustainable earnings. We're getting this at very attractive prices. But let's see if there's any other considerations that can add to our conviction, make the decision make the decision easier, safer, more rational. First off, this transition to data. This is a massive transition we've had over a little while. But China Mobile is well down the path, depending how you measure it. Probably 2/3 of their, 3/4 of their revenues are already tied to data. That is decreasing risk for them right now, not increasing risk for them. Debt always an issue for us. Knowing whether you can trust the amount of cash there. A school of thought out there that says the accounting in China is a major concern, and that cash is hard to measure. There still is zero debt on the balance sheet here, so we're giving no benefit for the cash reserves that sit on the balance sheet. And lastly, they are willing to share. They're paying a debt. They're paying dividends. It's maybe not quite as generous as we would like, but we're willing to give them a share with a dividend over 4%. These dividend payments in the long term matter a lot. So it's lovely that we're being paid to wait. That really improves your risk to return profile. And one last side point, again, just sort of interest, they're also the largest provider of broadband internet in China. They've been building this out over the last few years. They're not producing any profits on this. I don't think the market's giving them any credit for that. Must be worth something, and what you're saying, it might even be worth quite a lot. Those free options are very attractive. So even with end consumer prices under pressure from the government, that high capex, China is generating strong cash flows. It's trading at attractive valuations. It's got no debt. It's paying good dividends. If any of the headwinds change and exceed these low valuations, the share price does very well indeed. Back to the big picture, how does this fit back into the portfolio? Remember this slide. Each stock comes good as it turns out that these headwinds turn to be temporary. But let's go one step forward. These are very differentiated from each other. They all have very different underlying profit drivers, because that for us is portfolio management. It's about diversifying the underlying profit drivers. It's the factors that drive your revenues and the factors that drive your expenses. That's what matters, not where it's listed or what sector it's in. For those of you who are with us up in Copenhagen, I talked about a couple of companies, Sky New Zealand and Texwinka. Texwinka is a scale provider of fabrics to blue chip retailers. We also have something like Western Union, a global remittance business. We have exposure to the energy majors. Think about these companies, Sky, Texwinka, Western Union, Energy. They're very, very different underlying profit drivers. So there's no one factor that can affect a large percentage of the profits of these holdings. For us, that's robust portfolio management. China Mobile's got a great franchise, and it's got a very distinct risk profile, and it fits very well in a differentiated way into the rest of our portfolio. Coming on to the conclusion here, don't forget the world that we live in is not normal. The quantitative easing, the trillions of dollars we've seen in the last few weeks, there are trillions of dollars now trading at negative interest rates. We've got the central banks, balance sheets of the small planet. These are not signs of a normal world and financial system. But to give you the best chance of success in these uncertain times, you need to call on all aspects of fund management. Sensible and differentiated philosophy, that resolve to stick to it through thick and thin. Do your in-depth research. That can lead to conviction. Conviction makes it much easier to make sensible decisions. And then engage balanced portfolio management to add yet another layer of risk control. We think China Mobile is attractive. It's risk-focused, differentiated stock, and a powerful example showing all these aspects of fund management. Thank you very much.
Thank you. Any questions? Oh.
Which is conditioned whether these companies make money or not, and whether the focus is on the consumer or on the investment. So as China is centrally planned, what is their plan for China Mobile?
Yep, no questions about it. Government, as you say, regulation makes a huge difference. At the same time, they're also controlled by this is controlled by the company, by the government. As I said, we think they're facing a lot of the headwinds right now. The government is putting a lot of pressure and has brought down the rates aggressively recently. So putting huge pressure on that, that does affect the profitability. We think we're still getting at reasonable valuations, even with the risk of government intervention being very high. You look at it, there's no questions about it. The potential for governments to mess with it makes a huge difference. The thing that gives us a huge bit of comfort here is your position against your competitors. If the second and third player are much weaker, essentially the Chinese government has to say, we are going to target and we're going to destroy the profitability of one company, not the whole industry. And that is a big shift. We believe that we have some protection. There are no guarantees in this world, but we have some protection in their positioning in the industry. If you are the low-cost producer, if you're the strongest player, you have to see where the regulation will set to keep the third player in business, or possibly drive one player out of business. We think that because they're so much better positioned than the other, it gives you a huge protection against that factor.
Hi, what's your price target, and what do you think of the 5G capex?
So, as I said, capex is without question the highest one. We would love to see them drag the capex. Numbers just came out a few weeks ago. Capex is still very high. These guys are spending like no one's business. Did that for 4G. That's been the major concern around it. I still think that if you look at the 5G, we're just not sure that it's market ready. They figured out the standards. They figured out the lead time for the capability and the amount that they can, just producing enough equipment to actually make it. So we would love to see them have a year or two of a capex holiday, a capex low level. But no questions about it. They very well might continue to spend outrageous amounts of money, as they did with 4G. Our assumption on that, with the return on that stock, is still going to be mid 5% return. Even in the bad times, because again, their competitive position against the other. So you're making a 5% return. I think it's going to do better than that. I think if there's any let up in the negative, you're making a 10% return. You know, that high single digits, 10% return. That's quite attractive. We don't really deal in price targets, but what I put up here, these lines, our price target will be 20 times what we see sustainable earnings. We'll keep an eye on the sustainable earnings. We don't play with it very often, but we will adjust it upwards if we think we're being overly pessimistic over the years. But you know, essentially, we're saying the share price can double from here. 11 times, say, to that 20 times sustainable earnings is certainly, you know, if nothing changed, we think that would be an exit price for us.
Okay. Anybody? Oh, yeah. That was it.
Thank you very much for your presentation. I'm struggling a little bit I'm thinking about how it is possible in a sector which normally is struggling with debt. How is it possible that they have cash levels? So debt-free or even net cash? How could they finance the huge rollout of investments? I can say all the Telefonicas of the world are struggling with debt, huge debt positions.
It's got $60 billion in cash, if you believe the Chinese accountant. And a lot of people say don't believe it, but who knows? But the debt levels, like that is much harder to fiddle, even in Chinese accounting. The debt levels are much harder, is zero. There's nothing on the balance sheet. It just shows you how incredibly strong a position they have. They are, you know, you have to look at it in the context of China Telecom and China Unicom, which are the other two competitors. These guys they used to have the only mobile network in China until the Chinese government then told China Telecom, which used to have only the fixed line. China Telecom got into it. They had such a competitive advantage. You know, you've got 925 million customers and the highest quality customers in China. Absolutely unbelievable amount of cash flow. Just over time, they've, and then, you know, even trying their best with the CapEx levels that we were talking about, which have been extraordinarily high. The cash flow is even higher. It is just one of those situations around the world. You know, we have looked at telcos. You're right. Almost all of them are levered. China, the government isn't putting that pressure on them. They haven't done any silly buybacks, et cetera. So it's a very interesting opportunity.
Anybody else? Oh, yeah.
You just mentioned silly buybacks. They've signed on their last General Assembly a potential 10% buyback. And there's currently a 30% float. So this 10% of 30% could have a huge impact if they really have the cash. What's your view on that?
Yeah, you know, when I say silly buybacks, our view on buybacks is that you should buy back share prices when they're here and not buy back share prices when they're here. And in the US right now, you've had a massive leveraging up of the balance sheets across, and you're all buying at this point in the cycle. You know, that to us is silly buybacks. They may be right, but we find that very difficult. For our style, which is a reversion to mean, anti-momentum style, that's a pro-momentum. So that's in the US. On this one, for them to buy back, you know, the major concern you have with them is that they're an arm of the Chinese government. If they bought back 10% of the shares, that does terrible things to liquidity. I don't care about liquidity. Because we're not momentum players. We want to hold this stock for 10 years and make lovely returns for 10 years. I think if they were to buy back some of those shares, that is very sensible. At these prices, very, very sensible. I'd be very happy with that. It's you're getting free options. That's what you love to see. You want to see if things work out, you know, if everything goes horribly wrong, and I think it is very difficult for them right now because of the cash flow, we're going to do okay. And if you're getting enough free options like this, broadband internet is an absolute free option. The cash is a free option. The buybacks to us, those are free options. Those are the types of things that make a very attractive risk to reward.
Okay. Thank you very much.
Thank you.
We now